Greetings and salutations. Today we're going to look at the company OPRA, headquartered in Norway and traded on the Nasdaq under the ticker OPRA. Please stay tuned for the important disclosure information at the conclusion of this video. OPRA's journey began in 1995 in Oslo, Norway, when John Stevenson von Tetzschner and Geir Ivarsøy spun off a research project from Telenor, the Norwegian national phone company. Their goal was to create a faster, more efficient web browser that could run on limited hardware, a philosophy that eventually led to Opera's reputation as a pioneer in mobile browsing and data compression. For its first 2 decades, the company remained a European-led entity, carving out a niche as the innovator's browser by introducing features like tabs and speed dial long before they became industry standards. A massive turning point occurred in 2016 when the company's consumer business, including the browser and the OPRA brand name, was sold for approximately $600 million to a consortium of Chinese investors led by Kunlun Tech. This transition shifted the company's strategic focus and headquarters, eventually leading to its debut on the public markets. In July 2018, OPRA Limited officially listed on the Nasdaq stock market under the ticker symbol OPRA. In the years following its IPO, the company underwent a significant evolution. It moved away from being a general-purpose browser company to a diversified tech platform. Major changes included a heavy investment in AI-driven content discovery and the launch of Opera GX, the world's first browser specifically designed for gamers. Most recently, the company has pivoted toward high-value markets like Western Europe and North America, integrating native AI tools into its core products to compete in the modern browser landscape. As for the business model, it is built on the strategic monetization of a specialized user base, moving away from the one-size-fits-all approach of larger competitors. The company operates primarily through 2 revenue channels: advertising and search engine partnerships. By integrating search bars from partners like Google and Yandex directly into its interface, Opera earns a share of the revenue whenever users perform queries. Its advertising division, Opera Ads, leverages first-party data to sell highly targeted space within the browser's speed dial, bookmarks, and news feeds. This ecosystem has proven highly efficient, with the company reporting 2025 full-year revenue exceeding $608 million, a 26% year-over-year increase. A critical pillar of this model is Opera GX, the world's first browser designed specifically for gamers. By offering unique performance controls, such as CPU and RAM limiters, and integrating platforms like Discord and Twitch, Opera has captured a high-value niche. These users are particularly attractive to advertisers, as the gaming audience typically yields an average revenue per user more than double the company-wide average. Geographically, Opera has executed a massive pivot toward high average revenue per user Western markets, including North America and Europe, which now serve as its primary growth engines. While it maintains a massive footprint in emerging markets like Africa and Southeast Asia through Opera Mini, its focus has shifted toward high-value users who spend more online. This strategy is further bolstered by a recent push into AI-native browsing with Opera Neon and fintech through MiniPay, a stablecoin wallet that has already activated over 12 million users in emerging markets. Opera's business model uses advertising and search engine partnerships to generate revenue. The company integrates search bars from partners such as Google and Yandex. Opera earns money when users search. Opera Ads sells targeted advertising space within the browser. Since its strategic pivot in 2016, Opera Limited, OPRA, has transformed from a traditional browser company into a high-growth advertising and search engine platform. Following the 2016 sale of its consumer browser business to a Chinese consortium for $575 million, the company restructured its monetization model to move beyond simple software licensing. This shift was institutionalized with its 2018 IPO, after which Opera increasingly leveraged its browser real estate to serve as a massive top-of-funnel engine for advertisers and search partners. The modern revenue structure is defined by 3 primary pillars: advertising, search, and technology licensing. Advertising has emerged as the dominant growth driver, fueled by the OPRA ads platform and the success of the OPRA GX gaming browser. By focusing on high ARPU, average revenue per user, regions like North America and Europe, OPRA has significantly increased its monetization efficiency. For instance, by 2024, the United States alone accounted for over $256 million in revenue. OPRA's financial acceleration is best illustrated by its most recent performance. In 2024, advertising revenue jumped 38% year-over-year to $93.3 million in the fourth quarter alone. This surge is largely attributed to OPRA GX, which surpassed 33 million monthly active users. These gaming users are particularly lucrative, often generating an ARPU more than double that of a standard browser user. While the company maintains a significant international footprint, its strategy has deliberately leaned into the U.S. market, which now contributes nearly half of its total revenue. This geographic focus, combined with the integration of AI agents like ARIA, positions OPRA to capture premium segments of the internet audience, leading to an expected revenue total of over $608 million for 2025. The data presented in this table tracks OPRA's financial metamorphosis. In the initial years following the 2016 acquisition, the company operated at near-zero cash flow. This phase was defined by high research and development spend as the team modernized the legacy Presto engine and shifted toward Chromium, laying the groundwork for what would become a highly scalable mobile and gaming browser suite. Revenue in 2016 of $107 million was largely defensive, but by 2018, the listing on the NASDAQ signaled a shift toward aggressive user acquisition and monetization. The period between 2019 and 2021 marks a significant structural change. While revenue appeared to stall slightly in 2020 due to the pandemic's impact on travel-related search, the underlying profitability began to surge. This is most visible in the other row, which account for the massive non-cash adjustments and high-margin efficiency gains from the OPRA ads platform. By 2021, revenue grew by 52% to $251 million, and operating cash flow began its permanent climb toward double-digit margins. A critical element of OPRA's cash flow conversion is its efficient management of working capital and contract liabilities. Unlike traditional software companies with heavy inventory, OPRA's primary cash cycle involves collecting advertising and search revenue from partners like Google. The positive contract liability changes reflect upfront payments and long-term commitment from advertisers, providing a float that funds ongoing marketing efforts. By 2024, sales and marketing spend grew to $135.2 million, a necessary investment to fuel the rapid expansion of OPRA GX, which has become the company's highest ARPU, average revenue per user, product. The 2025 estimates reflect the culmination of this high ARPU strategy. With revenue surging past $608 million, the company has achieved significant operating leverage. Even as R&D and S&M expenses increase in absolute terms to support AI initiatives like the ARIA agent, they're decreasing as a percentage of total revenue. This has allowed free cash flow to reach an estimated $122.5 million for the 2025 fiscal year. Even after adjusting for stock-based compensation, which saw a jump in 2025 due to front-loaded RSU grants, the real cash return to the business remains at record levels, providing a stable foundation as the company enters 2026. The timeline of OPRA's capital allocation reveals three distinct phases of corporate maturity. The first phase, spanning from the 2018 IPO through 2019, was characterized by land grab investments. During this period, the company was technically cash flow negative after accounting for stock-based compensation, as it aggressively funded user acquisition and the early development of its OPRA News and gaming platforms. The $175 million cash pile seen in 2018 was largely the proceeds from its initial public offering, which the company utilized to simplify its ownership structure and acquire niche technology components to bolster its browser engine. The second phase, roughly between 2020 and 2022, marked a pivot toward aggressive share consolidation. As the company's high ARPU strategy in Western markets began to bear fruit, OPRA generated its first significant adjusted free cash flows. However, rather than initiating a dividend, management took advantage of what they viewed as a market undervaluation of their stock. The most notable event occurred in October 2022 when OPRA executed a massive $128.6 million repurchase of shares from 360 Security Technology, effectively reducing its total outstanding shares by over 20% in a single transaction. This move was highly accretive, ensuring that future cash flows would be distributed among a much smaller group of shareholders. The final and current phase, beginning in 2023 and continuing through 2025, reflects a mature total shareholder return model. In early 2023, OPRA announced its first-ever recurring dividend, which included a significant 80-cent per share special dividend to reward long-term holders. This transition was made possible by the stabilization of the OPRA GX revenue stream, which now provides a predictable annuity-like cash flow. By 2024, the company had settled into a rhythm of paying roughly $70 million in annual dividends while simultaneously continuing to buy back shares in the open market. Entering 2026, OPRA maintains a debt-free balance sheet with a cash and investments pillow of approximately $119 million. This liquidity serves as a strategic reserve for AI-related infrastructure and potential small-scale acquisitions. The company's ability to maintain this cash cushion while returning over $95 million to shareholders in 2025 alone highlights a remarkably efficient business model that converts nearly every dollar of its $608 million plus revenue into tangible value for its owners. OPRA Limited's leadership transition and ownership structure reflect its evolution into a major global technology subsidiary. Since October 10, 2025, the company has been led by Lin Song, who was elevated from his previous role as co-CEO to become the sole chief executive officer. Song is 44 years old and is a long-standing veteran of the organization, having first joined the group in Oslo, Norway, in 2002. His trajectory within the company is extensive, moving from early project management for mobile web browsing to chief operating officer in 2017, and then to co-CEO in 2020. This leadership change followed the decision of James Yahweh Zhou to step down as CEO, though Zhou remains a critical figure as the executive chairman. While specific, current year individual salary data for Lin Song is not explicitly detailed in recent financial reports, general executive compensation at the company averages approximately $269,296 annually, with the highest compensated executive reaching about $720,000. The company does utilize significant share-based compensation, which reached $6.0 million in the first quarter of 2025 alone, as the board granted 1.9 million share-equivalent RSUs to key leaders to be vested through 2028. The ownership of OPRA is heavily concentrated, with the Chinese company Kunlun Tech Company Limited maintaining majority control. Kunlun Tech owns approximately 69% of OPRA's shares, effectively making OPRA a consolidated subsidiary. Beyond this major strategic holder, institutional investors maintain a roughly 17% stake in the company. Individual retail investors and the general public hold the remaining portion, which is estimated at approximately 14% to 15% of the outstanding stock. The company has no long-term debt and a significant cash and short-term investments. The liquidation value is estimated at $298 million, or $3.42 per share. Let's build a scenario-based dividend discount model. In the bull case, OPRA successfully captures the AI native generation. By integrating advanced agentic tools like OPRA Neon and expanding its mini-pay fintech ecosystem across emerging markets, it becomes an indispensable tool for both productivity and finance. In this scenario, OPRA maintains high double-digit growth as it steals market share from legacy browsers, eventually becoming a dominant player in the Western e-commerce and gaming ad space. We can expect high operational efficiency and expanding margins, allowing for aggressive dividend growth and massive stock buybacks. The base case assumes Opera remains a highly profitable, specialized challenger browser. It continues to dominate the gaming niche with Opera GX, which grew users by 22% recently, while slowly growing its presence in high RPU Western markets. Growth eventually stabilizes to match the broader digital advertising market. Capital allocation remains balanced between a healthy 6% plus dividend yield and consistent, modest share repurchases. The company maintains its debt-free status and uses its cash pile for small, tactical acquisitions to keep its technology current without taking on excessive risk. The bear case sees Opera struggling against the walled gardens of Google and Apple. If major operating systems further restrict third-party browser integration, or if AI search becomes a commodity dominated by big tech, Opera's unique features could lose their competitive edge. In this scenario, user growth stalls, and the company is forced to spend more on marketing just to maintain its current base, causing margins to contract. Dividends would likely be capped or cut to preserve a cash pillow as the company pivots to more defensive, lower growth strategies, leading to a long-term stagnation of the stock price. In the bull case scenario, we assume the following: revenue growth at 18%, operating cash flow margin at 30%, capex growth at 12%, stock-based comp growth at 10%, dividends growth at 19%, stock repurchase, net of stock-based compensation, at 18%, acquisition spending in the next 20 years at $1 billion. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $65 worth of value per share in 20 years, $222 in 30 years, and $720 in 40 years. In the base case scenario, we assume the following: revenue growth at 10%, operating cash flow margin at 22%, capex growth at 8%, stock-based comp growth at 6%, dividends growth at 7%, stock repurchase, net of stock-based compensation, at 5%, acquisition spending in the next 20 years at $400 million. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $23 worth of value per share in 20 years, $40 in 30 years, and $62 in 40 years. In the bear case scenario, we assume the following: revenue growth at 4%, operating cash flow margin at 15%, capex growth at 3%, stock-based comp growth at 2%. After significant cuts, dividends continue to grow at 2%, stock repurchase, net of stock-based compensation, at 1%, acquisition spending in the next 20 years at $50 million. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $9 worth of value per share in 20 years, $11 in 30 years, and $12 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.